Charitable giving is something that I really don't push anybody to do, but I definitely bring it up. And what I've found is that most people are giving to charity, but they're not giving to charity in the most tax efficient way. I'm not here to tell you that you have to only give to charity in the most tax efficient way, but if you can combine charitable giving, the things that you want to do, with saving more on taxes, I think it's pretty much a no-brainer to do it that way. Every once in a while, I'll be on social media talking about charitable giving, and I'll have the random person argue with me. It's like, oh, just give to charity. Who cares about taxes? Or just pay your fair share of taxes. Like, who cares about it? And I just don't think that's the right way to look at it. Tax law is written the way it is, and your job is to use it the way that it's written, right? You're not doing anything wrong. People choosing to not follow the law and use the tax law are just leaving free dollars on the table. I think before we dive into it, I think we need to hit on a couple things. One of them is just understanding how charitable giving works. When you give to charity, what ends up happening is that's a deduction for you. But this is a deduction that you only benefit from if you actually are itemizing your deductions. If you take the standard deduction on your taxes, understand that charity is not going to benefit you unless you give enough to push you over the standard. Let's say that typically, you have 25,000 of itemized deductions. The standard deduction this year is 30K, and you give 7K to charity. Most people assume that they give 7K to charity and they benefit by a $7,000 deduction. But in this situation, you'd only get to 32,000 of itemized deductions versus 30 of the standard. So you only benefit really by $2,000. And so this is where it typically makes sense to look into some different tools to give to charity to benefit tax-wise. And again, I want to reiterate, you don't have to only do it this way. Like, this doesn't stop you from saying, hey, great, somebody needs my help, I'm going to give money to them. You can still do it, but you can still also use these tools. One of the tools that I really want to talk about first is just the most simple one, and that's lumping charitable giving into 1 year. Let's use an example where somebody has 25,000 of itemized deductions. This year, the standard is 30, and in a given year, they give 10K. If they give 10K this year, then they'll basically benefit by 5,000 of it. And then next year, they'd benefit from 5,000 of it. So they're basically going to get 35,000 and 35,000, so basically $70,000 of deductions. Or what they could do is they could do what's called lumping charitable giving into 1 year. What lumping charitable giving really means is, instead of giving this year and next year, this year you save every month, and then January of next year you give everything you should have given for 2025, and then you start giving monthly. So you basically get 2 years into one. Here's why this works. So what would happen is then in 2025, you would take the standard deduction, the 30K, right? So we have 30K, the other one we'd have 70 over 2 years. Now what ends up happening is we save this year, January comes, we give all 10,000, and then throughout 2026, we give another 20,000. Now what ends up happening is we had 25,000 of itemized deductions plus 20,000 of charitable giving. So that's 45,000 in last year, 30 in this year. That gets you 75,000 of itemized deductions versus if you took the standard or the other way, you would have got 70. $5,000 difference. So this isn't as big as people who do more, right? As your income scales and you give more, we go back to the example of 25. Let's say you give 20 a year. Save this year, take $30,000 standard deduction. Next year, give 40. So then you're at 65. 65 plus 30 is 95. What this lumping does is it just basically allows you to benefit more. If you're somebody that's over the standard deduction, lumping charitable giving isn't going to do as much for you unless you're saying, hey, normally I'm in the 24% bracket, but the next year I'm going to be in 37 because of, some big, deferred bonus or something coming up. And it would be better to happen in that tax year when I'm in a higher bracket. Lumping charitable giving is really kind of one of the best ways to make sure that you benefit more from charity. You can also pair this with a donor advised fund contribution if you want to. Basically put it all into a donor advised fund and then distribute whenever you want. That really gets us into number 2, which is using donor advised funds. Donor advised funds are basically charitable investment accounts. So there's Schwab Charity, Fidelity Charity, etc. And they're basically a 501(c) and they're an investment account. So what you can do is say, hey, I'm going to donate 40K to this investment account. I get the deduction in the year I give, but I don't have to distribute from there. So what we'll find is that we'll have a lot of clients do this in their highest income earning years. They have an abnormally high income earning year. They're finally in the 37% bracket when normally they're way lower. Let's do the next 5 years of charitable giving in this year to the donor advised fund. And then let's distribute basically every year, for 5 years. That's kind of the first option of doing it, but it's not using it to its full advantage. Using it to its full advantage would actually be donating stock. Normally, let's say, you're a high income person, you're already itemizing, I'm going to give 5 years to the donor advised fund, I'm going to give $50K. That's going to save me $50K by my marginal tax rate, state and fed. So if I'm in California, make over $1 million a year, $50K might save me $25K in taxes. But you can actually take this even a step further and donate stock to the donor advised fund. So this is something I talk about with my clients all the time. And I just went through it last week with somebody. They had $50,000 worth of stock that they paid $5K for a long time ago. So they have a $45,000 capital gain. So if they donate this stock to the donor advised fund, they still get that $50K deduction against their income, $25K of tax savings there in California, but they also avoid the $45,000 capital gain. So they would save 20% Fed, 3.8% net investment tax, 13% state. So basically 37%. So that's another $15K of tax savings right there. This means this person basically got $15K of tax savings there. They got 25 on the deduction against their income. So they gave $50K and it only cost them $10,000. Then that money can stay in the donor advised fund. It can be invested. It can grow, and then they can distribute it however they want, whenever they want in the future. Then you can use the cash that you would have donated to buy back that same stock and raise your cost basis. You spent about $10K to donate this. You took your $50K of cash, you bought back that stock. Now instead of $50K of that stock at a $5,000 cost basis, you actually have that $50,000 of stock at a $50,000 cost basis. This is something that our clients do very, very, very often. They're high income earners. They donate to charity often. They want to pair it with the best tax benefit. And what you can do is you can also do this with other types of investments. So we have some clients who do this with the business that they own before they sell it. You typically need to work with the right company to be able to make sure that this can get done. But they're going to say, hey, great, I have this company I've grown for 20 years. I'm going to sell it for $20 million. I'm going to donate 500,000 of it because I have like a $0 cost basis. And now all the rest of my life of charitable giving is fully funded in my highest income earning year. And I avoid such a massive long-term capital gain. The one thing to note here is when you donate stock, it has to be a stock at a long-term capital gain. If it's short-term, then it just gets you to that cost basis, not the current value. That's something that I want to make sure everybody knows and doesn't make that mistake. But you can potentially do this with private stock if it's allowed at your company. Some companies actually have the ability to partner with a DAF company and allow you to do it. You can do it with the company that you own. Then you can also obviously do it with any public equity. I typically like using Schwab, Fidelity. There's a company called DAFI. You can even do this with crypto by using the right company as well. These are all things that I want you to consider. But at the end of the day, right, if you are giving to charity, you want to make sure that you're benefiting from it tax-wise. I know giving to charity isn't just about taxes. And so if the only way you're never going to be anywhere close to itemizing, sure, just keep giving. Do that from the goodness of your heart. But if you do have the ability to lump charitable giving, use a donor advised fund, etc., it does make sense to do this and save extra on taxes. Because at the end of the day, the more you save on taxes, the more you can actually end up giving long term. Thank you for watching. If you enjoyed this video, please leave a like and go follow my page for more personal finance content. And as always, if you have any thoughts, please leave it in the comments below, and I promise to get back to each individual comment. See you next week.